First, find a position for a regular uptrend line, and then reference an area of major resistance potential, such as the bottom portion of this bearish continuation that also lines up with downswing points. After that, go from the lowest portion of the uptrend line to form a vertical line that will end horizontally in line with the highs of that bearish area we referenced. Then rotate the third point down to form the regular trend line, which means aligning this trend line with the second upswing point we referenced. Any portion of the uptrend line after the boundary of the wedge is theoretically weaker, but can still oppose falling price to some degree as it's being broken through. As the downtrend continues, we eventually get conditions suitable enough to apply this method again. We have those swing points for the basis of an uptrend line, and we can reference these areas overlapping with the area of a recent downswing point to reference highs for the top of the Fibonacci wedge. And just like before, we go from the lowest point of the lowest upswing point straight up to the highs of the recent downswing point and most immediate area of resistance. Then we rotate the third point down to form a trend line that is aligned from the first to second upswing point, except in this case the second upswing point can't be reached, because it's too short of a length, which was determined by the vertical portion of the wedge. We could move up to this area from the middle of a past bearish continuation, but it doesn't contain any major or clear downswing points, nor does this area overlap or line up with any downswing points that take place after it. However, this area above it does. So we start from those same lows. Next, we extend up to be horizontally in line with the highs of this new area. Naturally, this will result in a much longer trend line when we rotate the third point down to encompass the same second upswing point we referenced before. And again, we might get some interaction when price is in contact with the curved levels of the wedge. But this is a secondary characteristic of lesser importance. We focus on the trend line extending past the boundaries of the wedge, which is now potentially weaker at opposing falling price, even if selling volume isn't particularly high. Now you might be wondering why we chose this upswing point instead of this one, which appeared closer in time to the first one. That's because the resulting upswing did not send price over the highs of this first downswing point of our potentially developing uptrend, whereas the next upswing we referenced resulted in price surpassing that high. In this next situation, those conditions are present, as rising price from the second upswing point surpasses the highs of the first downswing point, which formed following the initial first upswing point. In terms of the highest point to reference, it's a clear decision here with the sharp peak, where it's nice to see some overlap with the same range where a bearish continuation took place. As usual, we form a vertical line from the level of the lowest point to the level of the highest point. Then we rotate the third point down to form a trend line that runs through the first and second upswing points. When price drops back down, we've already passed the boundary of the wedge. The trend line can still be a barrier to reaching lower prices, but these conditions are preferable from a bearish perspective to more easily break lower without an exceedingly large increase in selling volume, because by this time, selling pressure isn't as exhausted in proportion to when it was during the boundary of the wedge. During that time, relatively weak bullish volume and price movement was able to sustain a decent uptrend within the boundaries of the wedge in terms of price and time ranges, due to that section being a price and time range on the chart that had sold off proportionally too much to sustain a further drop.